Hi everyone, my name is Robin Speziale and I'm the national best-selling author of a book called Market Masters. In this video we're going to be talking about the famous economist, John Maynard Keynes. I won't go into Keynes's economic policies obviously for this video because this is geared towards the do-it-yourself investor. But what most people don't know is that Keynes, aside from that professional job of being an economist, he was a day trader and an investor. And he had years under his belt of investing. He shared some of his investing experiences and some things that he wrote. And there's this author recently, I believe it was 2013, who wrote the book Keynes Way to Wealth. And what the author John Wasik did was he compiled some of Keynes's writings and he distilled them. And in the book, I forget where, it's a pretty good book. I would pick it up in your library. Keynes Way to Wealth. Wasik, he lists out Keynes's 10 keys to wealth. And so I'm going to read Keynes's 10 keys from 1 to 10, and I'll start now. So this is all quoted from these excerpts from the book. So number 1, over time, stocks beat bonds. Although this is not always true, it depends upon the time period studied. It's generally true. From 1926 to 2011, large company stocks returned an average 9.8%, and small company stocks returned 11.9%, according to Ibbotson Associates. This compares to 6.1% for long-term corporate bonds and 3.5% for U.S. Treasury bills. If you want capital appreciation combined with income, then stocks are still a potent long-term choice for most investors. Number 2, speculation is a dangerous game. Keynes thought he could play the fluctuations in currency and commodity markets with his superior knowledge, quote unquote. It may be easy enough to digest a ream of statistics and figures about past and present market conditions, but your research may have no predictive value for the future. Number 3, probability is not the same as uncertainty. You may have some excellent analysts' estimates on earnings predictions and bond yields, or the latest technical charts in various cycles, but as Keynes discovered, it doesn't absolve you of the market's uncertainty about a stock or the economy. 4, opposed risks will help balance your portfolio. You need to invest in a mix of assets that are truly uncorrelated during market downturns to give you real diversification. 5, take advantage of the value quotient. In the 1930s, when markets were tumbling, Keynes decided to focus on the company's intrinsic value. How much was it worth when it was broken up? What was its franchise enterprise value or competitive advantage? What would generate profits into the future? Was it raising its dividends? Number 6, dividends don't lie. Dividends are paid out every quarter and represent a share of a company's earnings. When Keynes loaded up on utility companies in the 1930s, he did so to buffer his portfolio and to grab an income stream. Number 7, don't move with the crowd. Being a contrarian pays off. Find healthy, unloved companies and stick with them. You'll do much better finding underdogs and holding them than buying today's popular stocks and hoping they'll gain value. Number 8, invest for the long term. Even if the current environment looks dismal, if you have a long-range investment philosophy and policy and it still works for you given your appetite for risk, stick with it. Rebalance once a year to ensure that you're on course and not loading up in any one asset class. Number 9, invest passively. Given that you can't divine the state of long or short-term expectations because animal spirits are doing their mischief, put most of your money in cheap index funds. The cost difference that index funds offer is always in your favor and allows you to build more wealth. Now, again, as I said in other videos, I don't believe in putting most or all your money into index funds. I still believe that you can be a successful stock picker and generate alpha above and beyond market returns. Finally, Keynes's number 10 key here for investing successfully is drink more champagne. This is said to have been Keynes's one regret, that he had not enjoyed life and drank more bubbly. The object of investing is to ensure prosperity, not become obsessed with making money. So put your investing on autopilot with a sound plan that meets your goals and monitor it once a year, then go out and live. All right, guys, so this was John Maynard Keynes, the popular economist of our time, or of yesteryear, I should say. But his economic policies still live on. But what a lot of people don't know is that Keynes was a day trader and investor on the side, and he did generate a lot of wealth for himself. And there's a great book that I read, which all these 10 principles are from. It's called Keynes Way to Wealth, written by John F. Wasik, and I believe published in 2013. Definitely pick it up in the library. It's pretty good read, and it's quick too. Thanks, guys, for listening. Happy investing. If you have any questions for me, you can email me at r.speziale@gmail.com. Or you know what, check out my site. Go to robinspeziale.com. I have some more writings there on investing, different strategies, and how I run my own portfolio. Talk soon, guys.